Welcome to Talk Tickers, your deep dive into the critical signals from earnings calls that you really need to hear.
Hey there.
Today, we are analyzing a major emerging markets player, and their Q3 2025 results are, well, a pretty dramatic illustration of a strategy playing out almost exactly as planned.
Yeah, it's a rapid pivot, you know, from a traditional telecom carrier into a scaled digital operator.
And that's really the core tension here for you, the listener. It's how do you value a company that on the surface looks like a legacy telco?
Right, complete with all the geopolitical risk.
But it acts, it grows, and it monetizes like a digital platform.
Exactly. We've got a fantastic stack of sources on this one. We're going to cover the headline financial beat, the strategic roadmap, which involves Starlink, which is fascinating, and the specific metrics that I think really validate this whole transformation.
The central narrative is just pure reinvention. It's highlighted by this landmark operational milestone that the CEO called a defining moment.
And a big revision to their full year guidance. A positive one.
A very positive one. So we'll cover the numbers, the roadmap with their locally trained AI, and this surprisingly potent asset-light strategy they're running.
Let's start right there with the financials. For Q3 2025, it was another billion-dollar quarter. Revenue came in at $1.115 billion.
What is a slight beat, I believe.
A slight beat against analyst expectations, yeah. It shows 7.5% growth year over year in USD terms.
But that 7.5%, I mean, it only tells part of the story, right? Because that number includes strategic disposals the company made.
That's the key context. If you adjust for those asset sales, the underlying, the like-for-like revenue growth was actually closer to an exceptional 10% year over year.
Okay, so that shows some really strong organic demand for their services.
Exactly. Look, if the revenue growth was strong, profitability growth was explosive. EBITDA surged 19.7% year over year to hit $524 million. Now, this is the figure that really got the market excited.
I bet.
That performance pushed the consolidated EBITDA margin to 47.0%. That reflects somewhere between 410 and 480 basis points of expansion.
Almost 5 percentage points of margin expansion in a single year. That is huge.
It is.
That suggests the whole transformation is delivering some serious operational leverage, not just, top-line growth.
It is. The cost discipline is rigorous, and the structure of their new digital revenue streams is just inherently higher margin. They are maximizing their existing network by layering software services on top. It's the classic multiplier effect.
Okay, now we have to address the elephant in the room immediately. Because if you only looked at the headline news, you might have walked away pretty concerned.
You're talking about the GAAP earnings per share.
Yeah, it showed a significant loss of what, negative $1.84? That missed consensus badly.
This is a textbook case of needing to read past the headline. Management was extremely keen to stress that this loss was purely non-cash, just accounting noise. We're talking about $259 million in non-cash charges.
So what were those charges exactly? This is where it gets a little dense.
It relates entirely to the structure of the Kyivstar listing, the one they did via a SPAC. The charges are a technical liability on the balance sheet connected to the SPAC sponsor shares and a currency loss from the sale of their Kyrgyzstan operation.
So think of it less like money leaving their bank account.
And more like a legal necessity of, crystallizing value from those assets.
So if you ignore the paper shuffling, which management basically told investors to do, the underlying business is actually in excellent health.
Absolutely. And the proof is that despite that headline loss, the underlying business still contributed a positive $76 million to shareholder equity in the quarter.
So the fundamentals, the cash flow, the margin expansion, that was all untouched by the SPAC accounting.
Untouched.
Okay, let's transition from that messy balance sheet to the strategic operations. This is what management really wants us to focus on, and it's where the investment thesis changes pretty dramatically. The CEO called Q3 a defining moment. Why?
Because, for the first time in the company's history, their monthly digital service users officially surpassed their traditional telecom SIM users.
Wow.
We're talking 143.3 million digital users. That is up a massive 39% year over year. They are no longer defined just by connectivity.
That is the ultimate validation of the strategy. It means they've successfully transitioned this massive customer base into active users of their higher margin software.
And the financial impact is, it's undeniable. Direct digital revenues grew an exceptional 63.1% year over year. They reached $198 million.
So this segment, which basically didn't exist a few years ago.
Now represents 17.8% of total group revenue, and that is accelerated growth compounding on a high base.
And here's where the implications for the business model become so important. The multi-play customers, so those using connectivity plus at least one digital service, they generate 3.8 times the average revenue per user, or ARPU, compared to the voice-only subscribers.
And that segment contributed over half, 55.4% of all customer revenues in Q3.
So what does that mean for you, the investor?
It's structural. When a legacy carrier starts getting 55% of its revenue from customers who are 3.8 times more valuable, it just fundamentally changes the investment profile of the company.
How so?
Well, they're moving from allocating capital purely to network infrastructure towers, fiber, all high capex stuff, to allocating capital to software platform development and AI. And that is a massive margin multiplier. It requires way less sustaining capex over the long term.
That's the pivot, from a utility provider to a platform company. And speaking of discipline, let's look at the balance sheet, where this success is finally showing up. Leverage improved sharply.
It did. Net debt excluding leases fell to 1.13 times last 12 months EBITDA. That's down significantly from 1.32x just 3 months prior in June. That is serious deleveraging momentum.
Wait, 1.13x is healthy, especially for a telco. But given all the FX volatility in their emerging market footprint, I mean, we're talking Central Asia, Eastern Europe, are they really that resilient, or is management just sugarcoating things?
That's a fair challenge. Their defense is strong, though. Management explicitly stated that, and I'm quoting here, going concern uncertainties have been mitigated.
And what's backing that up?
They're backed by a staggering $1.666 billion in cash and deposits. That liquidity acts as a really powerful buffer against sudden macro shocks or FX devaluation, which is critical in these markets.
And part of reducing that risk is this asset-light strategy. So they're not just relying on digital growth, they're actively monetizing their infrastructure.
The Kyivstar listing via SPAC was the key action here. That move valued the asset at $2.8 billion, which is roughly 2.3 times its book value.
And crucially, they still own most of it.
They retain a controlling 89.6% stake, which alone is valued at about $2.5 billion. So they crystallize this massive latent equity value without giving up operational control.
So they essentially proved, through a market transaction, that the market was undervaluing that specific piece of their business by billions.
Exactly, and they're applying this playbook elsewhere. They are now moving forward with separating their towers in Ukraine, mirroring that broader strategy across the group.
And what's the goal there?
To free up capital and reduce that infrastructure cross-subsidization that just plagues so many legacy telcos globally.
And that cash flow is being reinvested into the innovation engine. The AI 1440 strategy. We hear this term, locally trained large language models. What does this AI strategy actually mean for a customer? Is it revolutionary, or is this just marketing fluff?
It's surprisingly deep. AI 1440 just means augmented intelligence for every minute of the day, a reference to the 1,440 minutes in a day. It's about embedding AI into every customer touch point.
And the locally trained LLMs, like this CAS LLM.
They're essential because they operate in 4 local languages, and they power what the company calls agentic features.
Okay, what are agentic features? Are they just complex chatbots?
They're more than that. They're tools that act on the user's behalf, predicting needs and automating responses. But what's fascinating is the immediate commercial application.
Right. AI recommendation engines are influencing viewing for nearly 35 million monthly users. They're driving almost 60% of video-on-demand plays on platforms like their Tamasha app.
So this isn't just R&D. This is embedded AI driving content consumption and engagement right now.
Which in turn drives that ARPU increase we just talked about.
Let's put a spotlight on the financial services segment. It's the largest part of their digital revenue, $107.5 million, up 32.6% year over year. We're talking about JazzCash in Pakistan.
Yeah, they completed the operational separation of JazzCash as a standalone entity. This move is designed purely to unlock value in Pakistan's fast-growing fintech market and, prepare it for future external investment.
The scale is just staggering. Gross transaction value rose 40% year over year. That represents 13% of Pakistan's GDP on a last 12 months basis.
And get this, they process over 80% of all RASP payments value.
Let's clarify what RASP payments are. That's the Prime Minister's National Digital Payment Rails. It's the country's core real-time payment infrastructure. Processing 80% of that value demonstrates near market dominance. That's huge for building long-term consumer trust.
But the real value here, as you've noted before, is the replicability. They detailed their micro-lending activity.
Correct. They dispersed an average of 153,000 digital nano loans on a single day in Q3.
And these are tiny loans.
Tiny loans, typically around $30 to $40, supporting small businesses and families. The fact that they have mastered the algorithmic risk management for these small, high-volume transactions, that's their hidden competitive edge.
And the CEO confirmed they plan to leverage this exact expertise in technology, the micro-lending platform, across other high-growth markets, specifically naming Bangladesh.
And that turns JazzCash from just a local success story into a core technology platform for group-wide expansion. They're exporting their digital IP, not just their telecom expertise.
Okay, shifting to forward-looking statements. The key positive takeaway, the thing that drove that initial 15% stock surge, was the raised guidance. What's the revised outlook for 2025?
So the company raised its full year 2025 local currency EBITDA growth outlook to 6-10-18%. That's up from the previous range of 14-16%.
And revenue.
Revenue growth guidance was maintained at 13-15% in local currency terms.
So faster expected profitability with maintained revenue growth. That screams operational confidence. And translating that to the dollar terms that global investors actually care about.
In USD terms, management now expects 10-11% EBITDA growth for the full year 2025. That double-digit USD EBITDA growth expectation, coupled with the strong operating leverage we saw in Q3, provided a huge sigh of relief for the market.
And that relief translated into a powerful market reaction. The stock surged nearly 15% on the day of the call. It heavily outperformed the broader market. Volume spiked to, 2.7 times the recent average?
Yeah, you could see the big money rushing in to reprice the stock based on that margin expansion and the accelerated digital story.
But while the immediate reaction was bullish, institutional positioning shows some lingering caution.
It does. The stock has pulled back approximately 11-12% since that initial spike, which suggests that the perennial geopolitical risks, specifically Ukraine, and just general emerging market risk sentiment still weigh heavily on the valuation multiple.
So the market is giving, but it's also taking back based on that macro fear.
Correct. However, management provided a direct answer to this caution. The board approved a new $100 million share and/or bond repurchase program.
Management putting its money where its mouth is.
Exactly. It provides a potential floor for the stock and shows confidence that the current valuation is unjustifiable based on the operational trajectory.
So looking ahead, key catalysts to watch would be progress on that buyback.
The buyback, the Starlink rollout milestones in Ukraine and Kazakhstan, that stems from their global agreement for direct-to-cell connectivity and any further tower monetization deals. These are the things that can shift the multiple again.
Okay, this brings us to the segment where we highlight the outrageous but plausible trade idea derived from these numbers.
And as always, we have to emphasize, this is not financial advice. We operate under the explicit caveat that this company faces unique geopolitical headwinds and, significant FX volatility across its markets.
Nonetheless, based on the material acceleration in digital revenue and the crystallized asset value, we have to pitch an outrageous but plausible trade idea. What's the pitch?
The trade is a long position. It's based on imminent multiple expansion driven by hidden digital value.
Okay, break that down.
Despite the recent pullback, the stock trades at a deep discount, potentially 3 to 4 times price to earnings. The market is valuing it like a legacy emerging market telco, entirely ignoring that exceptional 63% digital revenue growth and the value of assets being systematically crystallized.
But if the market is discounting it by that much, doesn't that imply the geopolitical risk is real? I mean, why bet against that entrenched market fear?
Because the execution is de-risking the future, even if the present is volatile. The Kyivstar SPAC listing alone proved the value is there. It surfaced $2.5 billion in retained equity value.
So the outrageous part is betting that the execution will eventually just force the market's hand.
Exactly. The consistent delivery of double-digit USD EBITDA growth and the asset-light strategy. It will do it eventually.
So we suggest buying now, expecting that multiple to expand dramatically toward global digital service peers, not just telco averages. And that would be driven by the Starlink partnership narrative, the AI strategy, and the ongoing $100 million buyback providing some downside protection.
It's a classic growth compounder story layered on top of a significant asset monetization story. The narrative lag is simply too large to sustain forever when the digital division is growing at 63% and leverage is dropping.
So to sum up, Q3 2025 was defined by two things: the digital user base milestone and a materially raised EBITDA outlook. The narrative is pure transformation, from a traditional carrier to a scaled digital operator, backed by improving margins and reduced leverage.
The focus remains squarely on operational execution in these high-growth markets, leveraging platforms like JazzCash for expansion and capitalizing on their internal AI stack and that global Starlink partnership to keep up that double-digit growth.
So the core question for you to mull over as you process these results is this. If you set aside the non-cash accounting loss, as management really stressed you should, is the underlying momentum sufficient to overcome the persistent perceived emerging market risk?
In other words, is that current valuation discount fundamentally unsustainable? Is the narrative of reinvention finally strong enough to permanently override the narrative of risk?
Something to think about.
Thank you for joining us for this deep dive into the earnings call. We encourage you to continue exploring the implications of this digital transition across frontier markets.